Good morning, everyone. So this is the financial literacy. So we're going to look at accounting concept. So the first concept that we get is capital. So capital refers to the contribution an owner makes to a business when it started. So capital can be in the form of cash, equipment, vehicles, or other assets. Now we will later on see what assets are. So capital increases the value of the ownership. Whenever we look at capital, there are two sources of capital. So the first one is own capital. Now, own capital refers to the capital contributed by the owner himself. So this is his savings, his inheritance, pension, or retirement money. Is borrowed capital. So this refers to the capital borrowed by the owner from a bank, friends, or family. Now we're going to see what assets are. So assets refers to all the assets or the property of a business. It increases the wealth or the net worth of a business. It is also called capital goods because it is used to generate an income. So there's two types of assets. The first one that we get is the current asset. So this includes cash as well as other items that can be converted into cash within 12 months. So examples are stocks, cash, debitors, currency, saving accounts, etc. The second one is non-current assets. So these are items that is more permanent in nature. So for example, it is lands and buildings, vehicles and equipment. Then we get liabilities. So it refers to the debts of the business. There is two types of liabilities. The first one is current liability. Now current liability is debt to be repaid within 12 months. Examples are short-term loans, credit cards and creditors. Then the second one that we get is the non-current liabilities. It's debts that take longer than a year to repay. For example, it is long-term loans or mortgage loans. The next thing that we're going to look at is income. Revenue refers to the money the business earns. The company can earn money from sales, service deliveries, and interest from the bank. Income increases the owner's equity. Expenses. So expenses refers to all the money that it takes to run a business day to day. It has no lasting value. Examples of these are wages and salaries, rent, advertising, stationery, trading licenses. Expenses reduces the owner's equity. Profit. The business makes a profit when the income exceeds the expenses. So how can we measure this? Income minus expenses is profit. Then loss. So the business makes a loss when its expenses are more than its revenue. So we can measure this by taking the expenses minus the revenue equals the loss. A budget. So a budget is a plan for the future. So the expected income is identified, then it is planned how this income will be spent over a specific period of time. When we look at savings, we can see that savings occur when you do not spend all your money and put a portion away for later use. If you save or invest money at the bank, you can earn interest on it. Money can also be stored in a safe place or at home. However, the safest place to save your money is at the bank. So, examples of the different types of saving accounts that we get at the bank. The first one is notice deposit. So this is when an amount is invested and you must give a notice before you can access that money. So interest can also be earned on this. Then we get the call deposit. So when an amount is invested, you can have access to the future funds at any times. Interest is also earned on this. Fixed deposit. When an amount is invested for a certain period at a fixed interest rate. So banking. So this refers to all the services provided by banks to businesses and private individuals. Examples of service offered by banks are cell phone and internet banking, bank statements, loans, payments to the third party, opening businesses, and saving and investment services. So if we look at financial records, so this refers to the information that the business keeps in order to accurately report on its financial affairs to the business. In other words, financial records provide very important financial information to all the stockholders of the business, such as its owners, its creditors, and its banks. So examples of financial records. The first one that we get is an income statement. Now, income statement calculates the business's profits or loss. Then we get the balance sheets. So this calculates the financial position or the value of the businesses. Bank statements. So this is received from the bank and it shows the company's transactions for the specific period. Then we get other documents. So this is, for examples, the checks, the invoices, and the receipts and the deposit slips. If we look at transactions, we can see a transaction occurs when its item is exchanged for something else. Usually it is for money. So if we think back, we did trading at the beginning of the year. Now, trading is the exchange of goods without using money. Transactions is a good for the exchange of money. So, for example, when you go to your local supermarket and buy a loaf of bread, you exchange the cash for the loaf of bread. So, a transaction took place. A source document originates from transactions. For example, cash registered slips, receipts, check counter sheets, and invoices. So these documents are used to complete the journals so that the complete set of financial records can be available to the owner and its managers to make informed decisions.